And then now we go and say, fine. Now it's the allotment of shares and debentures. And when did this happen? It happened on 31 August 2019. So now you can go and say number 2. Okay, let's just say A over here. A. Then this is for B. For B. Then for B, what are we doing? We are told to generalize the what? The allotment of shares and debentures, right? Then we are like, okay, fine. Allotment of shares and debentures. So now you're gonna go and start and allot what? This thingy. The ordinary shares also from the get-go. So now the date was what? 19 Jan. Oh, they're on August. They're on August 20.19, right? And then you see here, this will be what? We'll be allocating this application and allotment for that 700,000, right? You put it in there, put that 700,000 in here, you debit it, you're fine with that. And then what are we crediting? Our share capital. Share capital, SCE, we go in there, increase our share capital by what? 700,000. And then we're done with that one. And then we go to the next one. We go and allocate for what? The preference shares also as well. Allocation for that. Go in there, application and allotment for preference shares. Put in that 210,000. And then we say preference shares. SCE. And then we go in there and put in that to 10, right? And then now we allocate our what? Our debentures also as well. Go and put in that application and allotment from here. And then go and debit that 200,000 over here, and then say debentures and credit them. SFP 200,000, right? Then we're done with that particular transaction. And then what was required? Okay, it was the allotment of shares and debentures, and we've done that at this point in time. Then now number C, right? Number C. Now what do they want? They want the underwriter's commission, obligation, and payment. So now let's go and read this thing again. What information do we have over here? We are told that the full offer is underwritten by Schumann Ltd at a commission of 2.5%. So now 2.5% for Schumann for underwriting everything over here. And this is the what? The full offer, right? For the full offer, right? So the closing date of applications is around July 2019. Then now, what are we supposed to do? So for each and every one of these, we are going to underwrite and put in the commission for each and every one of these. So now, what do we go and say? Underwriter's commission. Also, at the very same time, you need to take note that there's a difference between what you call the shares and debentures. What did I say? I said earlier on is that the shares, the preference shares and share capital, they are what? Part of owner's equity. And the debenture is what? What you call a liability. So there will be different treatment when we will treat them differently when it comes to this particular point in time. So now when we come here, regarding the share capital, what will we do? Regarding the share capital, when we are accounting for the commission of the underwriter, what are we going to do? We're gonna say the commission to the underwriter is part of the cost to sell these particular shares. So now if that is the case, then we are supposed to what? Remove it from the amount that we are actually receiving from the public and reduce the value of the shares, because that's the cost to sell the shares to the public. So now we're gonna go and say we want to reduce our share capital. Reduce our share capital SCE. Now how much are we reducing our share capital by? They underwrote 100% of the shares, which were 100,000 shares, multiplied by what they were being offered for, how much, 7 rand per share, and multiplied by what their commission of the underwriter, right? And the commission is what, 2.5%. Then we put that in there, receiving 17,500, right? 17,500. And then we recognize the what, the liability. So what did they say? Recognize the commission. This is the commission. And then what, the obligation. Now the obligation that these people we have, under these people we have the underwriters. Underwriters commission. Underwriters commission, which is part of what, SFP, right? This is what, a liability to these people, right? We haven't paid them yet, so we are fine at this point. And then after this, what is going to happen? We need to go and say fine, end payment. They said end payment. So now when it comes to the payment, what are we going to do? We will go and say, now remember, we haven't received the money from these people over here when they underwrote. This was a receivable. So now we just need to go and reduce this receivable over here of 105,000 with this 17,500, and then they will circle the difference instead of us paying them and them paying us back. Now that's a waste of bank fees, right? We will end up paying unnecessary bank fees. So now what do? We first close this underwriter's commission and reduce this liability and remove this liability and close it off under the underwriter's receivable, right? Then now you go and say fine, we are closing off this underwriter's commission over here, which is what, 17,500, right? 17,500 by reducing the what, this underwriter's receivable over here, and we are reducing this receivable by that 17,500. Then we are go, and then now we can actually start paying, right? Actually, they will actually pay us. So now they will have to pay us in our bank account, SFP. And then how much are these people going to pay us? They owed us what? 105,000 minus the commission that we are actually supposed to pay them, right? So this is minus the commission. So now they're going to pay us what? 87,500. And then we go and say, now we remove our what? Underwriter's receivable, right? Now we remove this underwriter's receivable, this one over here. And then go in and do this. Sorry. Okay, and remove that underwriter's receivable. Now they have paid, they have received the shares, everything is fine with the ordinary shares. So now we need to go and account for what, the people are of the what, of the preference shares, right? Preference shares, they are oversubscribed and stuff like that. So now we need to deal with those people as well. Wait, let me check something. Allotment of shares and debentures. Wait. I think I made an error over here. Okay, let me just fix this, guys. Insert a line over here. Right, with the application and allotment in terms of the preference shares. One other transaction we were supposed to actually include was bank SFP, to show, remember that the shares, they were what, oversubscribed, right? They were oversubscribed. These people gave us more money than we actually needed. We did not need 60. We are not dealing with 60, offering 60,000 shares. We are actually offering what, 50,000 shares. So now we need to reverse, give back the people their money of the 10,000 shares. So now that's the transaction that we almost forgot. Okay, so now let's go and say over here on the application and allotment of preference shares, and say these people, they were not supposed to give us what, that 10,000 shares that they gave us, right? Or we can say they gave us 10,000, 60,000, and see, now we are offering what, 50,000 shares, right? Then multiply that by what, the offering amount of what, 250, right? Multiply by 250, and then there's 35,000 that we are supposed to reduce from there. And then now this amount is going to be only for what? The 50,000 shares. So it's going to be 50,000 shares that we actually are putting in as preference shares, multiplied by 3.5, 175, and then everything is fine after this. It equates to 210. Just if ever you want to double check, you can just say sum, and then it's 210. You're good to go. And then now, okay, coming back here, where were we? We were thingy. Okay, we just paid the thingy, the share capital. So now we are also gonna put in the thingy, deal with the commission and obligation, and then payment of the underwriter, right? So now let's go and deal with that, or payment by the underwriter. So now, yeah, regarding thingy, preference shares, we're gonna go and say fine, preference shares SCE, preference shares SCE. Now, how much do we owe these people commission? We owe them commission for what? For 50,000 shares, even though they did not purchase any shares, but we still owe them 50. That are the commission that we owe them. So it's for the shares are going to be valued at 3.5. We should at 3.5. Then we multiply that by what? Their commission, which is what? 2.5%, right? Multiplied by 2.5%. Then that's the amount for this, guys. 50,000 shares. And then you go and put in what? The application and allotment that we actually put in where? Oh, sorry, I mean thing, the what you call the underwriters commission. Just put it under here, underwriters commission, SFP, and then it's for that amount. And then after that, this is the commission, this is the obligation recognition, and then now we close off the what? We close off the amount that we actually owe these people and stuff like that, right? And now we have to remember that in this situation, they never underwrote anything, so now we just have to pay them their amount back, right? In this situation, since we did not combine the journals, we're gonna have to do another payment separately over here, right? So it's fine. That's fine with me. Right. What do you have? Gonna have to say now. What is happening with this Excel thing now? Okay, Excel is not pressing where I'm pressing. I don't know why. For some reason. Okay, it's fine. I'm just continue. What's happening? Okay, I don't understand what's happening now. Okay, I'm gonna have to go and say, you see now, Excel, what's happening? Hey, man. Okay. How do I deal with this? Oh, okay, now I think we're fine now. Okay, perfect. Okay, we said we had preference shares, right? And then we had the underwriters commission, which was this. Then we're done with that. And then now we need to recognize the payment of the underwriters receivable. Not underwriters receivable, underwriters commission. We wanted to write underwriters commission over here. And then we pay the underwriters commission. Go and say underwriters commission payment. And then the payment is going to be that full amount as it is. And then we're going to credit bank SFP. Then go in there, and then we're done with that. And then afterwards we go and deal with the next one, the next transaction. Okay, let me just put this in here so for you to remember. This is the share capital portion commission, share capital commission, right? And then let's just do that, share capital commission. And then this is the what? Preference shares commission. because you guys will be seeing a lot of journals and be like, hey, what's happening now? So at least when this will be your guideline to see everything that's happening. And then now we go into what? The commission obligation and thingy. Commission obligation and payment on debentures, right? So now we repeat the same process over and over again. But this time around, it's going to be different. What did I say about debentures? They are a liability, they are not owner's equity. So now the treatment of this particular transaction will be different. The underwriter's commission will be an expense. So now we'll go and say underwriter's expense, underwriter's commission expense, which goes into what? The statement of profit and loss. Right, and then we go and say how many debentures were we issuing? 2000 debentures. So we say 2000 debentures, which were issued for how much? They were being issued for 100,000 each. Actually, okay, 100,000 multiplied by that 95% discount, so it's going to be 100,000, 100 rand multiplied by 95%, 95% times the what? The 2%, 2.5% commission for the underwriters. So now it's what? 4,750, right? So 2,000 shares, 2,000 debentures, 800 rand, and then only 95% of that amount was being offered out, and then you're gonna be paying them 2.5% commission, right? And then there we go. And then when you continue with that, you say underwriters. Okay, I don't know why I've been using double T's, but it's fine. Okay, underwriters commission SFP. This is a liability at this point in time. And then after that, after you've recognized the liability, which is an expense also at the very same time, and then you circle it also as well, right? So now you go and say, fine, recognize this. We'll go and do this and remove this. And then put in bank SFP. Right, and then you put that in there. Now also, before you actually pay them, you have to remember one part of the transaction. Let me just remove this. They already have a receivables account. So now we need to remove that amount from their receivables, from the receivable that we actually are expecting to receive from them. So that's also another thing that we had to take note of. So now let's first also throw this into the receivables. Apologies about that. So now we go and say, fine, underwriter's commission. And then you put in that amount in there to go and reduce our receivables amount, right? This receivables amount over here, underwriters receivables, and then you fix that over there. And then now this is when the payment will actually happen. Now we are expecting to say underwriters receivable, and then on underwriters receivable we expected to receive what? Expecting to receive how much? This 47,500 for debentures, less what? This amount over here that was the commission that they were actually charging us, right? So this is how much we will actually receive from them, and then this will go into our bank account, bank SFP. This is what will actually go into our bank account, and then we are sorted, and then we are done with the what? With part C of this whole situation, right? Of the underwriter commission obligation and payment. The only thing left now is the provision for dividends declared 29 February 2020. And also you have to remember with debentures you do not receive dividends, you receive what? Thingy. Interest expense, right? We pay interest expense for debentures, and then for shares we pay dividends, right? So now let's go and do that, but also I'll also do the transaction for debentures, even though it was not part of the required. I'll just do that for completeness' sake, right? Then fine, debentures, debentures commission. Let me just, even though it's the whole transaction commission, since we were using commission the whole time, so it's fine. Let's just continue with that, right? And then now this is part D of the whole question. But the provision for dividend declared on 29 February 2020. Now let's go and look at the information. Debentures. The debentures issued during the year are redeemable at 31 August 2039. This is very important. They did not put this information for stupidity's sake or for fun. This is very important. This date, very important, but we'll get into that. Right, the debentures issued during the year are redeemable at 31 August 2039. Interest on the debentures is payable semi-annually. So now let's go and say, highlight this and say this is for debentures. Debentures, we are using what? The blue color. And interest on debentures is payable on what? Semi-annually in arrears. Semi-annually on 28 February and 31 August. Right? In arrears. Okay, fine. And then what other information do we have? On 29 February 2020, the directors declare a final dividend of 50 cents. So now this is the date they are talking about over there. This 2020 over here. Let's just put it in red. And then the directors declare a final dividend of 50 cents on the ordinary shares and on the remaining preference dividend. So now the remaining preference dividend, how much are they? Now they will receive what? 10% of their value, right? Then we continue with that. It is let's just highlight this, the 50% over here for the ordinary shares with purple, or for the final dividend, and then on the remaining preference dividends, so there's no need to highlight that. And then it is payable on 15 March, so this is going to be a liability to us to actually pay the shareholders on this date, right? And on this date, the following balances and totals appear amongst others in the books. Since we are not told to do ledgers or something like that, this will be fine. This will be just information for the sake of information. There's nothing we can do with this. There's no need to use it, but it's part of the liabilities if ever you are actually doing a thing, what you call, if you are doing your ledgers and SCE and stuff like that, then this would be very important. But at this point, there's no need for that, even though this was declared and stuff like that already before, right? And then, okay, fine, let's continue. So let's start with the simple stuff. The last transaction will be debentures. Before you guys get confused and stuff like that, I'll start with the portion that's for shares, right? So now, also on the side, you need to calculate what? Your share capital value, right? Share capital value would be how much is your share capital value actually at this point in time, right? So now you go back, you say, on your share capital at the beginning of the year, how much did we have on ordinary shares? We had 820,000. So you're gonna go and put in 820,000. 820,000 plus what? The shares that were actually allocated, right? Then you see on share capital we allocated what? 700,000 plus 700,000 minus what happened? The commission that we actually reduced the share capital by. So now you minus that by the commission that we actually reduced the thing by, right? And then we are fine and we are good to go. So this is the actual value of the share capital at this point in time. And how many shares? Number of shares. How many are they? You're gonna say we started with what? 160 shares. Plus, how many did we issue? We issued what? 100,000 shares. So 100,000 shares. And now let's go and complete our transaction over here, right? We're gonna go and say we received 50 cents on the ordinary shares. And then now we go in there and say fine, our shareholders for dividends. This is the amount that we're actually paying the shareholders, and then SCE over here. And then now how much are you actually paying our shareholders? For each value of their shares, these people are gonna be receiving what? 50 cent of this. All right. So now on that, now they're going to be receiving what, 50 cent on this, so 0.05. Then they're going to be receiving what, 75,125, the shareholders. And then we go and create what, a liability. Since we have not paid them, we will pay them what, on 15 March. Since we are paying them on 15 March, you go and recognize a liability after that instead of bank. Then we say dividends declared. Dividends declared, SFP. Print that 75,000 over there. Then it's shy with that transaction, right? We leave it like that, and then we come to what, the preference shares. The preference shares will also have to do what, find out what is their value at this point in time. So pref shares value, we got what, the value of the preference shares at the beginning of the year was 200,000 plus how much did we receive for preference shares. Now you go and check, say application and allotment, preference shares, there we go. Actually received what, 175,000, right? Plus 175,000, and then out of this whole money that is here, we're gonna pay these people what, 10% of the value of the preference shares. So it's gonna be 10%. So now, okay, just overstepped my thing. I actually did the actual transaction. Okay, it's fine. So now the actual value of the preference shares is 375,000, right? So now I'm gonna say shareholders for dividends. Say preference shareholders for dividends. Preference shareholders for dividends, SCE. Put that in there, and then we debit what? We debit this amount multiplied by that 10%, right? Then we've got that 37,500, and then this will be what, dividends declared. Dividends declared for who? For these people, for thing what you call, for dividends declared preference shares. Okay, but I'm not gonna write the whole name. Preference shares. Okay, it's fine. Preference shares. Okay, it's fine. Let me write it there. And then SFP, this is a liability. Then we put that in there. Finish with that. And then now we go into our what? We go into debentures. Okay. Stay with me here on this one. So please stay with me on this one. So now you have to remember with debentures, what happened on debentures. We had the underwriters, fine. We had the amount that we received from them, and then we had the debenture discount, which is a what? A contra liability, right? It is not an asset, it is a contra liability, a liability with the debit balance, right? And then the actual thingy, debentures are worth what? 200,000, all of them in total. So now, what were we told over here? We were told that debentures issued during the year are redeemable at 31 August 2039. So now, if ever the debentures are issued right now, remember when was everything completed? 31 August 2019, right? Since we completed everything on 31 August 2019, it means the debentures will be payable when? On 31 August 2039. So how many years is it in between? If 2019, it's going to be 2029, which is 10 years, and then another 10 years to make it what? 2039. So basically, we have what? 20 years. Debentures, let's say debentures, liable after 20 years. We're gonna have to pay them after 20 years. The reason why I'm taking note of this, it's because for the fact that we had a discount, this discount has to actually be reversed back into this thing, what you call the debentures account on the thing on the SFP, to actually make sure that it truly reflects the amount that we are supposed to pay our subscribers for debentures. So now what are you going to do at this point? You're going to go and say interest expense. They said what? Receive the thing, the interest and debentures is payable what? Semi-annually, or we actually pay the debentures semi-annually in areas on 28 February. We are not on 28 February, but 31 August, that is where we are. You understand? So if we are on 31 August, then we are supposed to start paying, right, for the current year. So now, which is 31 August 2020. Remember, we're in 2020. This was the last year. So now, interest expense. This is to show the value of actually borrowing, the actual borrowing cost of the loan, right? So now this is gonna be interest expense, SPL. You go in there and say now we're gonna take this amount over here. Where's that amount? It's hiding now. This amount of the debentures discount, which is 10,000, and then divide it by what? By 20 years. So we want to find out, Guti, how much are we actually supposed to pay in terms of what is the cost of the debentures interest expense for this current year, despite for the discount, actually, despite the actual people that actually subscribe to the debentures, right? This is not an actual cash flow, but it's a thingy. I could put it as an accrual basis of accounting situationship, right? So now this is not an actual cash flow, but we just want to reflect on our books, how are we actually, what is the actual cost of these debentures, right? So now it's the 20 years, and then divide by 2 due to the mere fact that they are payable one semi-annually. So now for this portion of the year, you're gonna have to pay what? 250 in interest expense, even though it's theoretically, and then reduce what you call reduce this this debentures discount account, and reduce that account by what? 250. Right, we're reducing the debentures expense account, right? And then now by 250, then we're done with that transaction, but we are not yet fully done. We need to now account for the actual interest that we're actually paying who? The actual subscribers of the thing of the debentures. So now what do? We go in there again and say, okay, fine, actual for the actual subscribers of the debentures, we have to pay them normally their interest expense, which goes to SPL also again. But now how much do we actually owe these people? Oh, we owe these people what? 9%. We should these debentures for what? 9%, right? So it's gonna be what? 2000 debentures multiplied by what? The 9% multiplied by what? The actual value of the debentures, which is what? 100 rands, instead of the 95 rands we actually paid due to the discount. So now you multiply by what? By 100, and then you've got 18,000 there going down there. And then now in this situation, we just make an assumption that we still owe them, we haven't paid them or anything like that, right? So since even the other ones are not paid yet, but we can actually, if ever we're paying them, we just credit bank. If we are not paying them, we just write thingy, what you call a payable to thingy for debentures or something like that, or debentures ticket in some sense of. But now let's just make it simple and say it's bank SFP. We paid them because there is liable what on 31 August, and 31 August is already hit, so it's fine. So bank SFP, then this will be the 18,000. So we have sorted everything out and answered every question that is there on this question paper. So if ever you have any questions, do hit me up, or do hit any other of the thing Gen Z Tutors. And you can find us on 067 925 6394 and book a lesson with us. and find out more information of how to actually better your education and be a better student. Thank you guys. That's it for today. Sibonge. Oh, before I forget, yes, I almost forgot. The thingy, how you call the interest expense over here? It's for 28 February, actually, not 31 August. Apologies on that. And also, it is payable. The interest is payable what semi-annually. So this interest expense, we need to also do what divided by two, and then we are good to go. And then that's all from me. Same thing with this interest expense for the debentures discount or amortization portion. It's gonna be for what? 28 February. So that's all for me. Thank you guys. Sibonge.